We're now joined by a very special guest. We spoke with Thomas Rookmaaker, Director Sovereign Ratings at Fitch Ratings, and I began by asking him that why has Fitch affirmed their ratings for India at BBB- with a stable outlook? Wasn't there a case for an upgrade?
Yeah, I mean, we have seen a number of positive developments in the past couple of years. So we've seen all these reforms which have been rolled out. We've seen inflation come down. The RBI MPC is building a track record in that regard. And we see high growth, and we expect growth to continue to be high. So there are some positive elements in India's credit profile, definitely. Also, the external balances are relatively strong. But, we look at all these countries that we rate on the basis of a number of metrics, and there are also a number of metrics which are not so favorable for India, and that includes, for instance, the business environment, the structural indicators, which are relatively weak, and also the fiscal position, which is also weak compared with peers with a high general government debt burden, and also a large fiscal deficit still. There is some fiscal consolidation in the center, but if you include the states, the level is high. The fiscal deficit is 6.6%, according to our estimate, which is much more than the median for those BBB category countries.
There are some questions being raised about the discrepancy in ratings even between the same class of countries. While India and China are classified together as emerging markets, China's ratings remain at A positive. While India languishes at the bottom of the investment grade ladder, China's growth has faltered, India's growth has improved. Is there a different approach in assessing these two countries?
Yeah, so we rate China at A+. And India at BBB-. So in China, what we're seeing is indeed a buildup of imbalances due to the debt that's being accumulated in the economy, and that is a worry. At the same time, there are some strengths in the Chinese economy as well. If we look at the development level, the Chinese economy is so much more developed than India's in the past 40 years. Its external balances are so strong. I think they have the highest reserves buffer of all countries in the world. So there are also positives in that respect that we take into account.
While China's reserves are strong, it is far more exposed to the external risk versus India. There is also a threat of a credit bubble in China. Doesn't that strengthen the case for India on a relative basis?
Yeah, so there are risks in China, and we are well aware of those risks. But they're not necessarily related to India's rating, I would say. For instance, if we look at the general government debt, we estimate that this debt, including the contingent liabilities coming from the local government financing vehicles, is 53% of GDP in China, and with this accumulation of debt, you might expect maybe a bit more of debt being migrated from, for instance, the corporate sector to the sovereign balance sheet. But still, this compares also on this metric relatively well to India, where we see a general government debt level of 68% of GDP, and where there are also contingent liabilities, for instance, from the banking sector.
The main concern for Fitch remains the weak fiscal position of the government, with the debt-to-GDP ratio coming in at 69.5%. China's debt-to-GDP ratio rose to 277% at the end of 2016. Japan's debt-to-GDP is 239% when it is rated A positive, with virtually no growth over the last decade. India has been consistently bringing down its debt from the peak of 84% in 2003, with a target to bring it down to 60% by 2023. Is this not good enough in your mind? Is it too slow?
Yeah, well, first on your last question, indeed, the debt level is very high compared with peers. So within this group of triple B rated countries, triple B category countries, so rated triple B minus, triple B flat, or triple B plus, of those countries, the median is 40%, and India's debt burden is 68%. And there are only two countries with a higher debt in that category, Aruba, small island in the Caribbean, and Hungary. Now, if you compare, to make the comparison to Japan or China, you have to realize that there are other metrics for which these countries score much better. For instance, in terms of how this economy is developed, how the governance system works there. In Japan is also more developed. So that's a more advanced economy, and I realize that the debt level is an issue, and the debt level is an issue in our discussions on the rating, obviously, as well there. But it's you have to realize that we compare all these countries, on the basis of a large number of indicators and not just one.
You have also cited difficult business environment in India. In the same breath, you have spoken of broadening of government structural reform agenda. How much of the difficult business environment is an impediment to growth, which you say is among the best in the world? You see GDP growth accelerating to 7.7% in FY18.
Yeah, so the growth indeed is high, but the business environment is relatively difficult. So, for instance, if you look at the ease of doing business indicators, India actually scores lowest among its peers for that indicator. And it doesn't only score below the triple B minus or the triple B category median, but also below the double B median and even below the B median. So the business environment is very weak. Now, with these reforms, you expect an improvement, and this can go faster than you might expect, actually. These kind of improvements, but in some countries it has happened that these kind of indicators actually improved quite a bit. But it's a gradual process still, and the level is still weak in India.
You have spoken about structural shift away from high inflation rates and strong external balance position in India. How does this sit with India's rating being retained at BBB minus? Yeah,
so again, we look at a large number of indicators. So we look at macroeconomic indicators. So for India, that's relatively strong growth and inflation, which is now more in check than it was in the past. Still a bit higher than compared to its peers. We look at the fiscals, all sorts of indicators there. External balances, strength for India, indeed, for the reasons that you mentioned. But we also look at structural indicators, and there India scores weaker than a country like Spain, for instance.
Can you speak of the structural indicators that are much weaker for India, that rein in rating agencies from an upgrade?
Yeah, so that's, for instance, the business environment, like I mentioned. It's also the governance standards. So for that, we also use the World Bank governance indicator, and you can think of issues like the income level per capita or GDP per capita, those kind of indicators. So which basically capture the development of the economy more broadly.
India has seen an improvement in governance indicators like the World Bank's Ease of Doing Business Index. Is this not good enough?
Yeah, no, it has seen an improvement. And also, if you read the newspapers, no longer see those big scams come up anymore, and there has been an improvement clearly, but yeah, you know, we try to use indicators which are available for all countries and which are, you know, clear, like the one from the World Bank. And if you look at, you know, that indicator, the governance in India is still much weaker than elsewhere.
You have cited Indian banks' bad loans as a concern. You believe that the banking system needs about 6 lakh crores or 6 trillion rupees in capital. The government has only committed about 700 billion rupees in capital till FY19. Do you see this as a risk to India's fiscal position?
Yes, well, I mean, we expect more recapitalization of Indian banks than has been budgeted so far. And the finance minister has indicated that he's willing to, you know, supply the capital that's needed for those public sector banks. So that makes it a fiscal issue, and it's likely that there will be some more, you know, money flowing from the government to those banks. But yeah, it's unclear to what extent that would lead to, for instance, less fiscal consolidation. So that remains to be seen, because, of course, it depends on decisions being made by the government.
When do you see ratings upgrade for India? What more will India have to do?
Yeah, so we basically look at two things in particular. One is, greater likelihood of the high government debt burden coming down, and the other one is you know, further improvement of the business environment, which includes, you know, reforms and also the inflation, you know, structurally lower inflation. So in that sense, you know, there is improvement already. And on the fiscal front, it will be interesting to see what the government is going to do with the FRBM committee report. So it's a very interesting report, especially that the idea to focus more on bringing down debt. And I mean, you can argue over whether, you know, how high debt should be, or, you know, the specific level, or what the path should be towards that level. But the interesting idea from a ratings perspective is especially, you know, the focus on bringing down the debt level. But so far it's a report of the committee. So now it will be interesting to see how committed the government will be to these kind of ideas.
What is the comfortable debt to GDP ratio for India? How soon will it have to get there?
Yeah, that's a very good question, but very difficult to answer, because we don't look at just specific levels for any of the indicators. As you can imagine, all these indicators are moving constantly, and so it's very difficult to say how it compares to its peers. Excuse me.
Thank you so much for joining us on NDTV Profit.
Most welcome. Thanks.